Fire insurance in California. Most unfortunately, earlier this year, in the aftermath of the Southern California wildfires, we witnessed an extreme economic consequence of overriding the laws of economics. When fires decimated the communities of Pacific Palisades and Altadena, thousands lost their homes, including a dozen Oak Tree employees. On top of the severe disruption of all aspects of their lives, many of them are suffering extremely negative financial consequences. This is because many were uninsured or underinsured, often as a result of actions taken by California insurance regulators. Most of California's government is firmly under the control of the Democratic Party, which generally leans toward a high level of activism in general and intervention in economic matters in particular. Notably, because the Democrats hold a supermajority in the state legislature and have little fear of potential Republican opponents, Democratic elected officials don't have to moderate their behavior to pass legislation or hold on to their seats. And just like the support for rent control, there's a lot of that in California, too. The government sought to help out homeowners by limiting the premiums companies could charge for fire insurance. In a sign of the times, I'll let my new and AI-powered editorial assistant, Perplexity, fill you in on the background. I've simplified the format and added emphasis, but I haven't changed a word. What follows below is pretty close to what I would have produced in an hour or two. Before the devastating fires of 2025, California's fire insurance market was already in a state of crisis, shaped by a combination of regulatory constraints, insurer withdrawals, and mounting wildfire risk. Insurers were prohibited from using forward-looking catastrophe models to set rates for wildfire risk. Instead, they were required by law to base their rates on historical average losses over the previous 20 years. This approach became increasingly problematic as wildfires grew more frequent and severe, making historical data a poor predictor of future risk. Regulations also prevented insurers from raising premiums to reflect increased reinsurance costs, further limiting their ability to price policies according to actual risk. Major insurers began withdrawing from the California market or ceasing to write new policies in fire-prone areas. Chubb stopped writing new policies for high-value homes in 2021. Allstate followed in 2022, and State Farm, the state's largest home insurer, stopped writing new policies in 2023. In 2024, State Farm announced non-renewals for over 70,000 policies statewide, including thousands in high-risk areas like Pacific Palisades and Altadena, just months before the 2025 fires. Other insurers, including Tokyo Marine America and its subsidiaries, also exited the market in 2024. Homeowners who managed to keep their policies often faced dramatic premium hikes. For example, some saw their annual premiums rise from $4,500 to $18,000. As a result, many property owners either lost coverage or could not afford to insure their properties, leading to widespread underinsurance. By the time of the 2025 fires, fewer than a quarter of affected properties were insured against fire. The state-backed FAIR plan, intended as a last resort insurance option, saw a surge in enrollment as private insurers withdrew. However, FAIR plan coverage is limited and more expensive than private insurance, often requiring supplemental policies to achieve adequate protection. The FAIR plan's exposure to wildfire risk increased dramatically, raising concerns about its solvency in the event of another catastrophic fire season. California law provided for a mandatory one-year moratorium on non-renewals and cancellations of residential insurance policies in areas affected by a declared state of emergency. This protection applied after major wildfires, but did not prevent insurers from withdrawing or refusing to renew policies before such emergencies were declared. The regulatory approval process for rate changes became increasingly slow, with the average time for approval rising from 157 days, 2013 to 2019, to 293 days, 2020 to 2022. This lag contributed to insurer frustration and market instability. As Perplexity notes, insurers were told they couldn't price fire policies to reflect increases in the frequency and severity of forest fires. Likewise, they couldn't raise prices to pass through the higher premiums their reinsurers were charging based on the increased frequency and severity. If a $5 million house has a 1% probability of burning down in a given year, and the insurance regulator says you can only charge $25,000 per year for a fire policy, what will you do? Note, I didn't need Perplexity to tell me the insurance company faces an expected payout of $50,000 on that policy, 1% of $5 million. The answer's simple. You don't write that policy. The lesson here is the same as with rent control, but rendered much more graphic by the catastrophic fires. Just as with rents, you can limit the price insurers can charge for coverage, but you can't make them provide coverage at that price. In this case, governmental efforts to enforce a non-free market solution deprived many of access to insurance, ultimately bringing misery to thousands.